Tom Lee reiterates yet again today he is bullish on small caps still, suggesting by this post he shares that you should just buy IWM and chill until next year. And by that point, you will be thanking him that you did that. But why do that when Nvidia is up 5% today? Joking, obviously, it's really all of your big tech stocks that are leading the way higher today. Apple's up 1%, Google's up 2%, Microsoft up 0.5%, and yes, then Nvidia that is leading the pack up over 5.5%. And the Nasdaq is now outperforming the S&P 500 by the largest margin in almost 30 years. Yes, even surpassing the peak of the dot-com bubble. As Zero Hedge shares on X, we are now as concentrated as the Great Depression. This is the top 10% of stocks by size versus the entire US stock market, and you're at 75%. So the top 10% of stocks in our markets equal 75% of the total market cap of our markets, which is kind of insane. You also have the S&P 500 tech sector's free cash flow yield at its lowest since March of 2002. And that's basically just saying it doesn't make a lot of sense to take risks in this market. Not with these valuations. Here you can see just the record bad breath that you've had in our markets with stock correlation within the S&P 500 that is approaching 20-year lows according to Bank of America. The equal weight S&P 500 relative to the market has dropped to levels last seen since 2008. And large speculators and hedge funds have moved swiftly back into net short territory for the S&P 500 futures. Ryan Dietrich, which is very bullish on our markets. He writes on X today, peak to trough max correction this year is only 5.5% for the S&P 500. This is historically quite low and suggests we probably see a larger pullback at some point during the year. Would be the smallest for an election year since 1972 at 5.1%. The average election year correction is 13.1% going back to 1950. And historically, the period of time you really want to watch out for during an election year is the second half of July, really through the end of September. You could say November as well, historically leads to pullback. And that's because there can be uncertainty before elections because we don't exactly know what policies will try to be enacted, how that will affect your money. I will say though, with this election, that you've already had both individuals serve a term as president. We already kind of know what to expect from both sides. So I'm not so sure we'll see a lot of election volatility. And if you're curious why I'm really defensive in markets right now, I wouldn't say necessarily bearish, but prepared for a larger correction or outright crash, look no further than Fed Bowman. Fed Bowman said today, I don't see any rate cuts for 2024, and she shifted her cuts to 2025. But this is the real kicker. Fed Bowman also said this morning, I'm still open to raising rates if inflation doesn't improve. Tom Lee recently said on X that he thinks the Fed will be late by a couple months cutting rates and effectively behind the curve. And that looks very obvious by Fed Bowman's comments today. We have now seen two good inflation reports, and according to the estimates that we can see for the next inflation report for this month of June, that's also looking good. And Fed Bowman's still talking about potentially raising rates as the unemployment rate has just hit a critical level, which is typically an inflection point where you see a rapid rise in unemployment. That is where you get a 0.6% rise from the bottom in unemployment. That would be like us going from 3.4% to 4% unemployment, which that did happen. Historically, when that happens, it leads to a rapid rise in unemployment. You have many barometers suggesting we're already in a recession, like manufacturing, consumer confidence, current conditions, so on and so forth. You also have the initial jobless claims numbers over the past 5 weeks now that are ramping higher, and we're still talking about raising rates. That would suggest to me the Fed's not even close to thinking about cutting rates. So you want to know why I'm concerned about this market? Look no further than the Federal Reserve that is about to make a critical policy error. If the Fed really wanted to avoid a hard landing, they would be cutting rates now. We will get more insights to how the economy is doing with FedEx that reports earnings today in after hours. Tomorrow morning, you will get Paychecks and General Mills. And then tomorrow in after hours, your biggest earnings of this week, I would argue, you have Micron, which does a lot of business directly with Nvidia. That stock's up almost 300% in the past 12 months. So it's definitely outperformed, to say the least. And then you have BlackBerry and Levi's as well as Jeffries. And then Thursday pre-market, Walgreens, McCormick, and Thursday and after hours, you have Nike. Market internals, yet again, today are terrible with the percent of stocks above the 50-day moving average. The best way that I like to measure how markets are doing internally, down 3.62% today. That means 3.62% of all stocks broke under their 50-day moving average. Only 39.18% of stocks are currently in an uptrend above their 50-day moving average. So over 60% of stocks are currently in a downtrend. Last time you were at these levels, the S&P 500 was in a 7, almost 8% correction back in the spring. And instead, now you are less than 1% away from all-time highs. So you're down about 1%. This is a very narrow market, a lot more narrow than what we have seen even throughout parts of this year. So I think earnings season is really the big test for your big tech names because expectations are so high. Any disappointment will be seen as very bad news. And I gotta say, I'm a little concerned about Apple's numbers considering their expectations that have just went through the roof now that Apple is over $210 per share. For a company like Apple that doesn't grow anymore, that is priced as if they are this magnificent growth stock, that could be problematic. Just to, I guess, point out one of them. This morning, we did have the Canadian inflation rate year over year that came in a little bit hotter, actually quite a bit hotter than expected. You were expecting 2.6%. The number came in at 2.9%, so not that great. Month over month came in way hotter than expected at 0.6% month over month for your core, and you were only expecting 0.2%. So that's really a slap in the face for the Canadian Central Bank that just started cutting rates and now seeing a really bad inflation report. You did have some mixed data as far as the Chicago Fed National Activity Index that came in at 0.18. You were expecting negative 0.4, so that came in much better than expected. S&P Case-Shiller home price month over month came in at positive 1.4%. You were expecting positive 1.1%, so higher than expected there. That's not exactly great news. Year over year came in at 7.2%. You were expecting 6.8%. Again, not exactly great news. CB consumer confidence came in slightly better than expected at 100.4. You were expecting 100. So slightly better there, but still this survey is in deep recessionary territory. So does it really matter? Not too much. Richmond Fed Manufacturing Index came in at negative 10. You were expecting positive 3. Really bad number there. Richmond Fed Manufacturing Shipments came in at negative 9. You were expecting positive 13. Really, really bad number there. Richmond Fed Services Index came in at negative 11. You were expecting positive 2. Really bad number, but markets see that as maybe some good news. Dallas Fed Services Index came in at negative 4.1. You were expecting negative 10, so better than expected. And Dallas Fed Services Revenues came in at positive 1.9. You were expecting positive 8. So some weakening across the board. It does look like, especially with your manufacturing data, your services data in the Richmond and the Dallas area. For your day tomorrow, you really don't have much. You have new home sales for May and new home sales month over month for the month of May coming out at 10 o'clock in the morning tomorrow. You will also get the bank stress test results at 4:30 p.m. tomorrow, and that could be interesting. Considering today, the FDIC warns that 63 banks have been added to the problem list as $517 billion in unrealized losses hit the U.S. banking system. But as I mentioned previously, Nvidia is really leading the market substantially higher today. If Nvidia was down again today, markets would be quite red. Now, Nvidia hit neutral on the RSI. God forbid Nvidia is a neutral company at any point. and you've seen a bounce. Markets seem to still want to keep Nvidia closer to overbought, if not extremely overbought, than neutral or, God forbid, oversold. So yes, there still is a frenzy within Nvidia. Ganja Benjiri, she covers markets and money at the Wall Street Journal and is a contributor to CNBC. She writes on X, the most active symbols on Interactive Brokers the past few days is tech, and more tech. Nvidia, number 1, Tesla, number 2, SMCI, number 3, AMD, and Micron, number 4th and number 5th. B of A's bull and bear indicator rose to 6.1 from 6.0. 4 out of 6 components are still bullish. That compares to CNN's Fear and Greed Index, which I like to look at a little bit more because it's incorporating the broader markets. That is in fear territory, hitting the lowest point that you have seen in many months. You have to go back to the spring to get a number that was lower than this. And this number is at 39. Again, I've never seen a market that is overbought on the S&P 500 that is less than 1% off of all-time highs, with the CNN Fear and Greed indicator at 39, which is pretty deep into fear territory. University of Michigan buying conditions for houses has now hit the lowest level you have seen since even before the 80s at about 22. Sven Hendrick on X says congrats and tags the Federal Reserve. Target announced today they will reduce prices on about 3,500 more items throughout the summer. Option activity expiring by this Friday is still very negative, with a put to call ratio of open interest sitting at almost 12. That means there's 12 times as many puts than calls for this Friday's expiration on the SPY, the ETF for the S&P 500. Open interest on the call side is 7.85%. Open interest on the put side is 92.15%. Here you can see today, interesting flow sentiment for the S&P 500 is tracking 32 different trades totaling $5.53 million with a positive order value of 21%. And take a look at this pretty ominous looking trade, a July 19th 425 put. Only worth about $15,000, but still, that's like throwing $15,000 in the fireplace. That would theoretically be a fall of almost 22% for the S&P by mid-July. That is a crazy bet. The most recent AI investor sentiment survey shows 44.4% of investors are bullish, neutral investors at 33.1%, and bearish investors at 22.5%. 10-year Treasury yields are trading down almost 1 basis point today. Your 10 2-year yield curve inversion is still inverted 46 basis points. You actually want to worry when you uninvert on the yield curve. That's historically when you're heading into a recession. Sentiment for the SPY, the ETF that tracks S&P 500 over on StockTwits, a pretty good barometer overall for retail investor enthusiasm or fear, has a sentiment score of 38, which is bearish. 1 point higher than yesterday though, which was bearish at 37. Message volume today is normal at 52, and the participation ratio is normal at 54. I do think FedEx earnings will be important today and after hours on the earnings throughout this week, and I do see a potential gap to fill down here to about 535 on the SPY if this week's earnings do disappoint, especially Micron on Wednesday, tomorrow. If not, then we see a broadening out of our markets. If earnings season goes well and the economy continues to hold up, then you see small caps, mid caps, and everything else start to do a little bit better. Big tech maybe takes a break here, and that could also fuel new all-time highs for the S&P and the NASDAQ. And let's be honest, that would be a much healthier market than what we are seeing on a day like today. So let me know what you think about all of this information down below in the comment section. Are you bullish? Are you bearish? Are you all in? Do you have some puts? Are you selling everything? Let me know what you think down below in the comment section. You guys have a fantastic rest of your day, and I will see you in the next one.